Uh, First of all, I would like to thank to the Secretariat of PEMNA here and Thailand also, of course, for welcoming us from Indonesia. Excellencies, distinguished delegates, ladies and gentlemen, it is a pleasure and great honor for me to be here to represent uh, the government of Indonesia at this 2023 PEMNA Treasury COP Bangkok meeting. Okay, today allow me to share with you some pertinent points in relation with our afternoon agenda, which is talk about the treasury risk management. If we talk about treasury risk and fiscal risk, it is quite relation. There is a hard relation between fiscal and treasury. And if we see from the framework here, we can see the fiscal cycle from the fiscal framework itself, the fiscal policy and implementation to the budget preparation, then budget execution, and then the consolidated reporting. The treasury risk is the part of the fiscal risk. So it is the part of the big picture of the fiscal risk itself. If we talk about the fiscal risk, before we go to the treasury risk, we can see that there are three main indicators that we can represent here. This is what happened in Indonesia, and we are sorry not to present the number here because at the December still a ongoing process. So we just explain about the up and down and the graphic itself. For the first things, the talking about the fiscal risk of Indonesia in 2002, it can be described in three indicators: liquidity, vulnerability, and sustainability indicators. In the liquidity, during the 2022, the level of current budget balance reached a positive value here. Compared to the previous year, which had negative value. Also, the net budget financing and ratio of natural resources to term foreign liabilities run into slightly increase. We can conclude that in 2022, there is a strengthening in revenue to support liquidity and also the rise of natural resources capability to support the need of liabilities. If we go to the next, vulnerability, talking about this part, we may describe that the indicator in three indicators. The first thing is debt service ratio, the next is interest ratio, and the last is debt to income ratio. And these three indicators show the lower ratio compared to the previous year and the average of the last 5 years. And this indicates that Indonesia shows better capacity to manage our vulnerability. And the last indicator here is about sustainability. In 2022, the primary balance, the debt to GDP and real interest rates show negative ratio. Primary balance has a better positive than previous year. And for the debt to GDP and interest rate are lower than the previous year. And this indicator that show that the stronger fiscal performance, better revenue, and lessening dependency to the debt. Talking about the fiscal risk in Indonesia, we will encounter several variables that may affect to the fiscal health. We cannot avoid but be worried about, we concerned and about the positive value and the optimistic value that we can gain. The first is about worried. The global inflationary pressure followed by the interest rate uptrend and downtrend of the economic growth. Recession begins in the several countries also. Reversal of the capital flows from the emerging markets include Indonesia, high cost debt, increased refinancing risk, and the cost of the new debt. The potential stagflation in the midst of the recession. That's the worried things that we should be careful. And the concern, we concern about the impact of the falling export on manufacture may increase layoffs in industry, such as labor intensive, for example, textile and footwear. The decline of the investor demand for domestic debt instrument. Also, the decline exchange rate potentially increase the cost of government and corporation debt. Also, potential revenue fluctuate depends on the global economy. But we also have a positive value that we may face in the 2023 about the global commodity price turned volatile and still high in 2023. The increase of inflation rate under control after the impact of rise of fuel prices and I thought out with the price of a commodity controlling as causes of inflation. The optimistic things that we still have a positive value in the next year, in this year, is the balance of trade surplus is expected to keep going and the growth expected to be reached positive. Going to the risk of macroeconomics, the increased macroeconomic risk due to the global factors and uncertainty. The risk in 2022, it is increased on the bond yield, capital outflow, and the beginning of the rupiah to the level of 15,700 due to the global inflation pressures and the decline of the demand for the manufactured export, especially consumer goods for developed countries, has a potential to the cause layoff in the solid sector industries such as textiles and footwear. But in the risk projection in 2023, the ongoing Russian and Ukraine wars as well as US-China geopolitical tension causing its fluctuation, global commodity prices, particularly in energy. Decreasing demand from investor for domestic debt instrument, reversal of capital flows from emerging market, including Indonesia. A decrease in the exchange rate has the potential to increase the burden of the debt issuance of the government and corporation. But we have also mitigation here. The gradual fiscal consolidation policy through the optimizing the taxation sector, controlled and targeted spending as well as debt issuance in the measurable manner. Observing a global financial market condition and financial market stock experience for the bond stabilization purposes, as well intensive coordination between Ministry of Finance, the central bank, and the authority of financial stabilization. Supervision of the good distribution chains to reduce the inflation rate. The next one is the risk of the revenue. The risk of the revenue in 2022 is low level but projected slightly higher in the 2023. In 2022, we have may face the upside risk because of the potential tax revenue for the year of 2022 is projected beyond target, still an ongoing process now. Non-tax realization at the end of 2022 estimated to be 15% greater compared to the realization of 2021. The positive trend of economic recovery both from consumption and production. And the risk projection in 2023, we may capture that the potential income tax revenue, oil and gas, and oil and non-tax revenue on 2023 potentially not as high as 2022, but potentially not because due to the higher price of the commodity, but 2023 dynamically projected, so it is still project up and down. Revenue of income tax and duties in 2023 potentially lower than 2022 due to the business contraction, but and no additional revenue from the voluntary disclosure program like in 2022. The mitigation that we do in 2023, the income exploration from non-commodity sector by digitization of tax, and then optimizing the revenue in sectors that have grown well and observing the risk revenue of 2023. The revenue optimization through the supervision in maintaining taxpayer compliance, intensification and extensification, strengthening the non-tax revenue database, improving regulations and IT. And the risk of expenditure, the risk of spending accumulation at the end of 2022, and the risk of spending absorption in 2023 depend on the absorption of the spending unit or ministries. If we look at to the 2022, the spending realization is still below the target and trigger the contraction, small contraction, but in business. But in service to the society are becoming less optimal. So the realization of infrastructure development is below the target. Spending absorption in 2022 is projected lowest than in 5 years. In 2022, also the potential budget surplus is projected to remain high. The capital expenditure is still low due to the performance of ministries. Absorption is not really optimal. This is our projection, but we still have optimistic because of several efforts from the Ministry of Finance to build the confidence of a ministry to absorb in the beginning of the 2023, because still we have a budget surplus, so we can spend the money to realize the absorption in the beginning of 2023. The realization of subsidies in 2022 is higher than in 2021, influenced by acceleration of disbursement and increase in disbursement value and increase in ICP. The need for subsidy in other compensation spending in 2023 is potentially higher because of the dynamic situation. The fluctuation in energy commodity create subsidy and compensation spending. And mitigation here, spending acceleration in the last month and December support by cash management as well as maintaining the efficient budget surplus position. The withdrawal acceleration of the capital expenditure to support the economic activity and realization of the accelerated infrastructure development. Acceleration of investment financing in productive sectors, optimizing the payment of spending obligation by using budget surplus. And also optimization budget surplus to anticipate the spending deficit. The last one for the fiscal risk is the risk of financing. The risk of financing is in 2022 is very low, but slightly higher in 2023 because of the global situation. In 2022, we have a high revenue and low spending because of the net budget financing high and deficit projection become low, and this is become the cause of the upside risk. The reduction in foreign currency debt issuance as a result in global central bank interest rates stronger follows the Fed's tightening that has been done 4 times, reached 3.75. And in 2023, the potential downtrend in demand of the domestic bank toward the bonds due to the banking appetite for dispersing more credit. The potential outflow of bond market is consistent with outflow of the several emerging markets. The potential capital outflow expensive cost of the debt of 2023. The issuance of the foreign currency bond is increasing due to the high level of yield because of the potential increase in 2003 because of the global market interest rate. It is higher. And also the need of the financing become higher in 2023. The mitigation that we may do in 2023 is adjustment of debt issuance target by consideration of the risk and optimal cost. If there is a turmoil event in the market, change need to be made on the composition of the debt financing by optimization of the loans, and also considering the medium and long to mitigate refinancing risk and foreign currency dynamic situation. The optimizing domestic and potential foreign financing also still be a concern in 2023. Providing a cash buffer for 2023 through the budget surplus of 2022. We are going to the Treasury risk. Okay. If you talk about the treasury risk, we can divide from the pillars of the cash management. In Indonesia, we divide into the 4 level here, level 1 until level 4. The level 1 is account management. The second is virtual account or TSA management, treasury single account, and then accurate cash forecasting. And then the last is cash optimization for the government revenue. Because of the level 1 is already passed a few years ago, then the position for the level 1 is going to be the TSA management of virtual account here. For the virtual account and the TSA management, we consolidate the all government account, and this space virtual account is applied on spending unit and public service agency, and also e-banking for transaction and reporting for reporting, TSA and VA account for spending unit and PSA revenue and expenditure. Cashless implementation. This is also implemented in the second level. The accurate cash forecasting here about the capability to forecast cash accurately. At this stage, we forecast the cash accurately and also provide the system to support the cash forecasting. The last one, the cash optimization. This is the capability to optimize cash using the short-term instrument. At this level, we are doing the good governance at the account management, accurate cash forecasting, cash mismatch management, buffer cash implementation, placement, cash surplus deposit or T-bills, availability of the cash management. The importance of the risk assessment and management responsibilities of the cash manager are often underestimated, but they are include the following risks. The first is liquidity risk. This is ensuring the liquid funds that are available and avoiding the overdraft or expensive emergency facilities. The second is funding risk. This is the securing the ability to raise funds at the market yield when required. The third is forecasting risk, making the decision on the basis of imperfect estimates of the borrowing requirement with insufficient information of the volatility or lumpiness of the underlying cash flows. The next is market risk associated with the management of the cash balances, credit risk relating to the investment of counterparties, and the next and the last one is the operational risk associated with the transactions, payment, and account. So from the 3 pillars, we can conclude the risk into the each pillars. For the first one, the implementation of this TSA, there is the operational risk. The operational here is unconsolidated. For example, is unconsolidated account lead to the unreliability report and frauds. And the second is ineffective and inefficient revenue and expenditure mechanism. We can describe here that the risk of operational are identified accounts, unsupported system and information technology, Limitation to the use of a new system or technology, the mechanism of revenue collecting system, not optimally reach all parties, inefficient expenditure mechanism between the spending unit and the cash management office, the risk of the settlement failure, and the risk of ineligible and fraud management. The second one is in the pillar of cash forecasting, there is a forecasting and liquidity risk. The cash mismatch, a projected revenue not matched with the expenditure because of the time differences, resulting in inefficiency of the government outputs and outcome. For example, inaccuracy of the cash withdrawal plans from spending unit from ministries, inaccuracy of the revenue and expenditure projection from the liquidity unit at the Treasury office itself, and the last is the uncontrollable economic condition. The third one is about the cash optimization, and there's so many here. There is operational, funding, liquidity, credit, and market risk. For example, inadequate human resources with knowledge to optimize the cash. And then a miscoordination between the cash management, central bank, and debt management. And because here we divide the authority of cash management and debt management into different office. The third is not optimal remuneration from utilization of funds of government account. And then a market pressure on bond issuance, risk escalation of counterparties, and interest rates uptrend. How to mitigate all the risks above, we can describe here. For the operational risk that is in the TSA management, we integrate all the government revenue from tax, non-tax grant financing, and expenditure from central government expenditure transfer to local government and financing expenditure into one consolidated account. Consolidating cash resources outside the Treasury single account into such as a public service agency and sui generis, and this is include the cash surplus withdrawal or private placement. And the next is the sustainably enhancing the mechanism of the revenue collecting system and expenditure system, building monitoring system for settlement, and the last is developing internal compliance in the management. For operational and liquidity risk, we can mitigate by the two systems. The first one is top-down. This is the cash planning information network. The cash planning information network consists of all representative of Echelon 1 in the Ministry of Finance, whose duties and function are to manage state expenditure and revenues. The spin team send projected data of monthly and daily revenue expenditure and revenue. Based on the spin projection data, the Ministry of Finance prepare the cash flow projection and analyze the data. Now, and then the second one, the bottom up, is from the spending unit or the ministries. The spending units prepare the monthly and daily activity plans, withdrawal plans, and then the spending unit also submit the daily forecasting to the local Treasury office, the branch of Treasury office, for the last transaction with disbursement to period of 3 to 7 working days. The cash forecasting data is used to manage the cash flow. The last part is about the optimization of the cash flow. We have several risks here: operational, funding, liquidity, credit risk, market risk that can cause the cost inefficiency. We do several things to do here: training and coordination. Training is for certification for human resources to build an adequate knowledge employee to optimize cash management. The second one is intensify the coordination between cash management and a central bank with monthly meeting forum. And the third one is intensify the coordination between cash management office and debt management office in the asset liability committee forum. For funding and liquidity risk, we can develop a various instruments when there are cash excess and cash shortage. For cash excess, we can place our money at a central bank here and in IDR or foreign currency, and also optimization outside central bank. We can place in the commercial bank, including Syariah at commercial bank, and Treasury notional pooling. Treasury notional pooling is collect the data of the cash surplus in every ministries, and then we collect the remuneration from the bank that handled the cash surplus. If we meet the cash shortages, we can accumulate it with the budget surplus. Budget surplus as a bridging helps the cash flow operation so that the cash shortage can be overcome. And then the withdrawal from the bank placement, the repo transactions, bond sales on the secondary market, treasury bill issuance, and also the last one is withdrawal from the public service agency surpluses. Also, in the funding and liquidity risk, we have a joint KPI because the cash management and the debt management is different offices. So we have a joint key performance index on optimization to debt interest index KPI. Then we for a credit risk, we develop credit risk scoring. So every counterparty we manage to have a credit risk scoring and have a limitation for counterparty to have a placement. And the last one is about market risk. We can mitigate by the short-term bond less than 1 year and less than 100 in price. And for reverse repo transaction, we have haircut implementation to mitigate the market risk. This is the case study of Indonesia. Yeah, this is the first slide here about the case study is about how we mitigate the fiscal risk in Indonesia. So we make a spreadsheet before mitigation and after the mitigation. From the impact and probability, we can conclude the risk level of each before and after the mitigation. So we can conclude in the risk map, it will going up or it will going down. Here we can capture from the risk map. So we are doing this in every high level meeting in every month. The next one is how we mitigate the fiscal risk. This is the case study, how we mitigate the balancing, how we balance the debt issuance and cash optimization, because sometimes when the debt management office issue more debt in some periods, so it may result in cash surplus. So we have to make a cash optimization. So we should control the balancing of these two functions with a joint KPI. The name of the KPI is optimization to debt interest index. This joint KPI is aims to integrate the balance of debt issuance and cash optimizations along with the cash forecasting. Before 2022, the consolidation between cash management and debt management is still need to build a synergy. But from 2020 until now, Ministry of Finance achieved the best KPI within the score index of about 3.5 until 4, still a best position here. And even though there is a fluctuation around that 3.5 until 4. Based on experience, market interest rate has a great influence on how much cost of fund in every period. This achievement supported by both depth of management and cash management office to monitor and report in ALCO forum, this high-level meeting, about revenue and expenditure trend and the impact on cash and cost of fund. To mitigate and overcome issues, the ALCO forum discusses and proposes the recommendation, for example, expenditure acceleration, debt controlling, and buffer cash optimization. And this KPI can be the effective anchor for cash balance, for fiscal balance. Yes. Last but not least, I hope that our discussion in PEMNA in this early year bring a goodness in effort to improve the treasury going forward. Thank you.